Hi guys, and welcome to the final video of 2017 for us here at Capital Rev. There's a lot to go through in a relatively short period of time, so let's just get right to it. Today I want to talk about real estate, because you guys want to talk about real estate. I want to talk about interest rates and debt, and the related issue of why central bankers aren't actually as in control as we think they are. A great paper just came out by Eugene Fama, or a paper I've just discovered, which I think is really interesting and important. And I also want to reveal one of my weirder hobbies. And I've got a bunch of weird hobbies, so this would put it in the running for weirdest hobby worldwide. So let's get to it. So first, real estate. 2017 was terrible for residential real estate. The last 3 quarters in particular saw price drops across every major metropolitan center in the country. And I think that trend is going to continue and actually accelerate into 2018 because we're obviously entering into the era of the stress test. For those of you who don't know, the stress test is a system where no matter what the size of your down payment is, you have to qualify for the interest rate you're being charged plus 200 basis points or plus 2%. And that's going to put a torpedo in the residential real estate market, especially the high end of the market that which you find in places like Toronto and Vancouver. And so I expect further price drops in those markets as 2018 unfolds. And that's going to have serious consequences for the economy, given that residential real estate represents 12% of our GDP up here. Turning very briefly to the debt picture in Canada, I think that's going to be another sort of drag on the Canadian economy in 2018. Debt has reached an all-time high of $2.11 trillion as we head into 2018. That's 171% of disposable income, if memory serves. And 2.11 trillion, to put that number in perspective, that's a huge number. 2.11 trillion seconds, for instance, is a little over 68,000 years, or about 11 times longer than we've had human civilization. So 2.11 trillion, the amount of debt we owe, is obviously colossal. And I think it's 1.4 trillion of that is represented by mortgages, and the other 700 billion odd is the difference between what we've had in terms of earnings and what we've had in terms of consumption. So at some point that's going to hit a wall, and the sugar high that the Canadian economy's got from this $700 billion of excess spending, excess over income, is actually going to turn into a sugar crash as we have to start paying that stuff down. The other problem with this colossal amount of debt in this country is the fact that interest rates are starting to rise globally, right? So just like central bankers acted in unison in 2008, 2009 and onward to lower interest rates, they're starting to act in unison to raise interest rates come hell or high water, no matter what's happening in their economy. So in the United States, for example, they didn't raise rates not once, not twice, but thrice in 2017. Canada raised rates twice in 2017, the first time they raised since 2010, and we slashed in 2015 actually up in Canada. Okay, so to sum up so far, residential real estate represents 12% of our GDP. Residential real estate has started to fall in 2017 and is probably going to continue to fall, and maybe the fall is going to accelerate as the stress test comes into effect. Debt levels are at all-time highs. Interest rates are starting to rise. What would that lead you to conclude about the Canadian economy and how it's expected to do over the next 3 to 5 years? You'd expect that it's going to start to slow as aggregate demand actually gets pushed downward, because that sugar high we've gotten from the party that was low interest rates, that's coming to an end. And at the end of every party, it sucks. We're going to have a sugar crash. Asset prices are obviously negatively affected by this pernicious combination of falling real estate prices, rising interest rates, excessive levels of debt, and so on. That's going to slow the economy, and that's going to harm asset prices, which is going to further impact the wealth effect, and on it goes into this vicious cycle downward. So I'm not actually optimistic at all about the Canadian economy, at least in 2018. But you may ask, can central bankers not save us? Can they not rescue us the way they did in 2008, 2009? Well, first, they didn't rescue us, and second, no. There's a lot to it, and I'll cover the issues why in future videos, but to check out some really great research on the power that central bankers have, or the lack thereof, check out Eugene Fama's paper. I'll leave it in the link below. I sometimes don't agree with Eugene Fama, but he is a brilliant man, and I suggest you acquaint yourself with his research. If you want to know what I think about interest rates, look at Newt Wicksell and the natural rate of interest. I did a video on it. I'll leave the link below. Last, I'm going to talk a little bit about my weird hobby. I can come up with all kinds of ideas about the Canadian economy from my ivory tower here encased in my charcoal drawings, but that only gives me so much insight. I need to get out to the street and I need to talk to people. And my hobby is that every holiday season I go out to different stores and I ask the general managers of those retail stores how business is doing. So this year I went out to 48 shops in different neighborhoods in Toronto, and I asked the manager or asked a staffer, is business more robust, less robust, or about the same as it was this time last year? And 42 of those 48 shops said that business is actually markedly down. Of the 6 that said that it's up, it's only up slightly, and what they're finding is that fewer people are buying larger amounts and they're using credit cards to do it. So it's obviously not a statistically significant sample, but it furthers my confidence in my argument that the Canadian economy is not going to do spectacularly well in 2018, 2019. We've been a consumer-driven economy for a while, and consumers are starting to tighten their belts for a host of reasons. Employment's up, but it's just not a great picture in my view. And yes, it is a weird hobby. I go around and talk to store managers. I think that's a weird hobby. That's just me. So guys, that about does her. Wraps are all up. The last 2 weeks of 2017 have been fantastic being back in front of you people. Before that, it was also fantastic. I'm really looking forward to 2018. For the 6 or 7 of you who are watching, I hope you have a happy new year. I hope you have a prosperous and wonderful and healthy 2018. And I hope you look forward to watching these videos as 2018 and beyond unfolds, as much as I'm looking forward to researching them, writing them, filming them, editing them, posting them. Thanks very much. Happy New Year. See you next time.
Birds come and cry there and twitter in the chimney, but I go forever and come again.